It's time we check in and look at how things are going. We've already entered into March. We're kicking off the year to an exciting start. And already, just a couple months, the S&P 500 is up over 8%. It's a pretty good start for the year. We're in a bull market. Things are going up like crazy. The QQQ is up 10% for the year. So the indices are doing really well this year, but I want to know which companies in the indices specifically are lifting the markets. Which ones are really putting in the gains? We're going to be looking at the top 10 best performing stocks in the market. We're also going to be looking at the top 10 worst performing stocks, the losers, the ones that are really being sold off this year. So we'll be looking at that with the market, but I also want to look at my portfolio. We have the story fund here. This is my growth portfolio. It's just in a handful of companies. I want to look at the year-to-date performance and see how this is doing. And then, of course, we have the passive income portfolio. This is my bigger portfolio, and I want to see what the returns look like this year. And we're going to see what's working and what's not working, because some of the companies in the portfolio are doing a lot better than others. So we're going to be checking in on all of this, seeing how it's going. And even though it's been a couple months, I know that this is short term, I still think it's really interesting to look at how things are doing. We're going to be looking at all of these different companies, seeing what's working and not working. Now, if you like this type of content, be sure to ring that bell below the video. That gives you notifications whenever I upload. Now let's go ahead and start off with the story fund. This is the smaller of my two portfolios, but it's one that I've tracked publicly since the beginning. It currently has $49,000 in gains with a total value of $211,000. Now, I'll be honest, this year has been fantastic for this portfolio. The whole past year has been fantastic for this portfolio. The reason why is because over half of the portfolio, over 50%, is in these two companies, Amazon and Netflix. If we look at either of these, for example, if we pull up Netflix here in Qualtrim, we can see that the company is up 32% year to date. Huge run this year. And this is off of the back of a really good earnings report where Netflix reported that they gained 13 million subscribers. Wall Street was expecting around 8 million, and they just blew past expectations. They also raised their guidance. They said that margins were going up. They said that they're reaccelerating revenue growth. Everything that you could feed to investors that was positive, Netflix did in this past quarter. So that caused the stock to go up big time. Over the past year, it's also been just an incredible performer, up 99% in the past year. So with Netflix being 30% of the portfolio, 1/3 of it, it has obviously driven the gains of this portfolio a lot in the past year and year to date. Being up 33% year to date is huge. If we look at Amazon, this is another one that's off to an incredible start this year. A lot of people are excited about Amazon, I think rightly so. Their free cash flow story, margin expansion, advertising, them getting costs under control, reducing CapEx, all the things that you would look for in a company right now, I think Amazon is another one that has them. It's up 19% year to date. So it's again one of the best performers in the market this year. If we look at the past 1 year, it's up 91%. So just to put this in perspective, in the story fund, my top holding is up 90% in the past trailing year. And then the second one that's also 30% is up 99%. So the rapid recovery in the story fund is due to these two holdings. I bought a lot more of them on the dip, but in the past 1 year, the portfolio has gained a combined $85,000 in value, bringing it deep out of the red into the green, $50,000 into the green. These two companies have really lifted up the portfolio. Another one that's helping out a lot is Microsoft. I don't want to forget about Microsoft because their performance year to date has been incredible. It's up 12.2%. Over the past year, it's up 62%. So not quite as good as Amazon or Netflix, but not bad. Their performance has again been incredible. Now, if we look at the two companies that haven't done as well this year, it's Google and S&P Global. Both of these companies have different reasons they're not performing. But let's go ahead and take a look at Google. This one is a 15% position. So it's still really big. I'm still bullish on Google. In fact, I'm in the green, but it has not had a good start to this year. Google's facing an innovator's dilemma, meaning that there's a new way to search for information and retrieve it, and Google either has to adapt it, but if they adapt it, do their margins stay the same? Are they going to lose market share to potential competitors? There's all of these many concerns about Google's core business, which is search. On top of that, Google has released a lot of botched releases, like their Gemini release. They've had multiple problems with it. They've actually retracted it and they're working on it. So Google's in a tight spot right now, causing the stock to continually sell off. It's down 3.26% just today. This year, Google is in the red year to date by 4%. So it's actually not rallied at all with the market or with the QQQ. Again, the QQQ is up 10%. The S&P 500 is up 8%. Google's down 4%. This is because of different issues Google's facing. The next company that has done poorly year to date is S&P Global. This is a much smaller position in the story fund with only an 8.7% weighting. So it's still a big position, but it's just a lot smaller than these other ones. S&P Global is down 2.3% year to date. So it's in the red this year. And part of that is attributed to their soft guidance on their earnings. You can see that they were trending up into their earnings, and then their earnings report right there caused the stock to sell down, giving up this year's gains. So you lost a couple months of gains in this company. Now, over the past year, it's up 21%, compounding on schedule. This isn't really in the basket of hyper growth tech companies, but S&P Global is a fantastic company. I don't see anything fundamentally wrong with it. I don't see any really big risks. So I've been buying more of it as it's selling off. When we look at all of these companies together, we can visualize them using the dip finder. When I bring up year to date, this is what the portfolio looks like. Google and S&P Global are in the red by a couple percentage points, and then every other company after that is outperforming the S&P 500. For example, if we were to add in the S&P 500, we can see that right here as the benchmark. The S&P 500 year to date is performed like this. It's right there. These two companies, Google and S&P Global, have underperformed. And Microsoft, Amazon, and Netflix have outperformed by a huge amount. Now, the important thing here too is that Amazon and Netflix are, again, by far the biggest positions. They're making up over half the portfolio. So the portfolio overall is outperforming. Even if we look at this on the past trailing year, we can compare the S&P 500 against these holdings and see dramatic outperformance of the story fund. There is the S&P 500 performance the past year. The only company to underperform is S&P Global, and just barely. I mean, just barely over the past year. Google has outperformed, Microsoft has, Amazon has, and Netflix has. These companies have led to the dramatic rebound in this portfolio. If we look at this visualized all time, we can see it again here. This is the past 1 year, from 2023 to 2024. Going way below, right here we were way below the S&P 500, and now we have creeped out above it. Now we're outperforming SPY by around 5%. So I'm really happy with the story fund's performance this year. So far year to date, it's up 17%. And Amazon and Netflix are off to a really good start. I think that Google's going to recover. It may take time. It may sell off further, but I really believe it will have a comeback. I don't know for sure, but I think it's going to come out on top. Now let's go ahead and move on to the passive income portfolio. We can take a look at how this one's doing. Every month I release a monthly update with some thoughts on the market, what I think's going on, my allocation, and my performance calculated with time-weighted returns. So I look at this, and this is the time-weighted returns of this portfolio over the past couple of years and year to date. This year, it's actually not doing as great. It's not outperforming to a large degree, not as much as I would hope. In fact, so far this year, we're basically head-to-head with the S&P 500. 7.82% returns against the S&P 500, 7.11. That was updated as of 1 day ago, one business day ago. So this is basically matching SPY, which is not what I want to do. I want my portfolio to outperform the S&P 500, but this is only 2 months. So it is shorter term, and we've had a run of a couple good years. 2022, we did a little bit better. 2023, we had a really good run. Some companies did fantastic. 2024, we're having a couple companies struggle. So let's go ahead and take a look at these companies that are struggling. The easiest way to visualize this is with the dip finder. We can look at the passive income portfolio here. This is what the portfolio looks like. And we have the S&P 500 in there as well. So the benchmark looks right about here. Again, 8% returns. That's the benchmark that I'm trying to beat. And we can see that a couple companies are dramatically outperforming and a few companies are dramatically underperforming. Let's go ahead and kick it off with the underperformers. We have Vici as the biggest underperformer. It is down nearly 9% year to date. Let's go ahead and take a look at how this looks in my holding. If we bring up Vici, it's in the real estate category. I invested in this one a while back, so even though it's not doing well this year, I'm still in the green by around $7,300, but Vici has been an underperformer. The company pays a solid dividend, and the dividend has grown over the past couple of years, but the stock price is getting no appreciation even during a huge bull market. And it's no fun when you have a stock that's staying completely flat when the rest of the market's going up. We can see this visualized here. If we look at Vici over the past 5 years, we can see that over the past couple of years, Vici has stayed relatively the same price while paying around a 7% yield. So investors aren't getting nothing here. They are getting a yield, and that makes up for a big portion of the gains. But on a stock price, it's just staying flat. And this has been the issue. I believe the primary issue with Vici is extra sensitivity to interest rates. As interest rates rise, same with money market accounts, same with savings account yields, which are somewhat competitive to the yield that Vici pays. So as savings account yields rise, Vici's relative value proposition is lowered. Now, the worst case scenario for Vici is for interest rates to rise more and more this year. That'd be the absolute worst scenario. Even if interest rates stay flat, that's not good for Vici. The best outcome is if interest rates come down. I think the stock will pop if that happens. But if interest rates look like they're going up, or if they're going to rise further, this one's going to be a big loser. The other one that's not doing well this year is Apple. Year to date, Apple's down 6%. And just today, it's down 3% off of news that the EU is fining Apple for their dealing with music applications like Spotify. Spotify has met with the EU regulators 65 times to complain against Apple during their investigation, and now it's been released that they have a $1.8 billion fine that they're levying on Apple. So this is something where it's governmental risk, regulation risk in Europe. Apple's going to fight this. They have their side of the story. The EU has theirs. Spotify has theirs. All these parties are self-interested. So I think there's going to be a battle here. But this is the type of thing to expect with Apple. They're going to have to pay these fines along the way. But these two companies, Apple and Vici, have dragged down the portfolio this year. They are underperforming. The best performing one in my portfolio year to date, which has over doubled the performance of the S&P 500, is Texas Roadhouse. This company has been incredible. I bought Texas Roadhouse just a couple years ago, and the company has performed so well. The stock price has appreciated so much that it's now my 4th largest position. It's bigger than Microsoft, bigger than Apple. It is a massive position in my portfolio. It's now trading at 150, which is incredible. This company has been a really quick double in my portfolio. I remember buying it when it was $70 per share, when people are concerned about restaurants, but I went to Texas Roadhouse and it was completely packed. I looked on the app every single weekend, every single evening, this place was packed. And to me, that felt like the Peter Lynch scenario, where you go to Dunkin' Donuts, you see the lines out the door, you buy the stock because you know the earnings are going to grow. And what Texas Roadhouse has done is grown the earnings. So this has been an incredible one. So far this year, just year to date, it's up 26%. So it's doing really well. Over the past 1 year, it's up 43%. So this has been a great story. And as far as I can tell, the story's on track. So even though it's a restaurant, it doesn't have as strong a moat as other companies. I believe the incredible execution, the great brand loyalty, the exceptional operations of the company, the way that they're able to own this many restaurants and execute on a daily basis, I think does give them a competitive advantage. So even though this has grown to a massive position, I'm still hanging on to it. I'm not selling a single share. The next two are other companies that have to deal with food and selling food. We have Chipotle, which is up a staggering amount this year. We were just looking at Texas Roadhouse. Here's Chipotle. We're in the green by $9,000 on this company. If we look at Chipotle now, it's pushing $2,700 per share. The company is up 19% year to date. So it's another story of a fast-growing food chain. I've thought that food chains are going to do really well this year, and I tried to pick the ones that I think will do the best out of the pack. After Chipotle, we have it again, a company that just doesn't seem to slow down, which is Costco. This one confounds a lot of people. It's just so confusing. Why does Costco always do so well? Why does it trade at valuations that seem extreme? The valuations seem crazy. Like, look at any PE ratio, price to free cash flow, anything with Costco, and it seems like it's trading at the price of some type of hyper growth stock. I've owned Costco for a long period of time, and it's one of the companies that I've been the biggest proponent of, the biggest advocate, getting investors interested in at least looking at least considering this company as an investment. I've made video after video after video after video after video on Costco because I feel so strongly about this company. So I'm one of the ones where I won't shut up about Costco. I just think it's such a phenomenal company, but the performance has really done well over the past couple of years. Currently, Costco's at $760 per share. Year to date, it's up 17%. Over the past trailing year, it's up 58%. Past 5 years, 247%. Now keep in mind, again, this does not count. It doesn't factor in dividends. And Costco paid such a massive dividend this last year that it was over 1 year worth of earnings. They paid $15 in a special dividend. That is a massive amount to pay out to investors, and to have the stock appreciate at the same time. Investors are getting gains both ways. So this has been a massive winner. Now that we've seen my portfolios, what's working and what's not working, let's go ahead and take a look at the market. Here we have a list of the top performing companies in the S&P 500 year to date. And at the very top of the list is a company that will surprise no one. The best performing stock in the market year to date is Nvidia, with a staggering 72% return. Is that right? Are we really up 72% with Nvidia? That is just incredible. It's now at $866. Today it's up 5.31%. So 5.3% just today. Just another day for Nvidia, up another 5 or 6%. Shares of the semiconductor stock are trading higher amid overall tech sector strength, as well as continued AI momentum. That's very broad. There's not much specifically happening today, but just because we're in a bull market and Nvidia has been the epitome of this bull market, it has incredible amounts of momentum. And I'm talking insane amounts of momentum. 79% year to date. We have it right there. If we look at this over the past 1 year, it's up 267%. So it's just outlandish returns here. Now, obviously, the metrics justify this. Their fiscal year 24, $60.9 billion. Look at the revenue jump from 1 year to the next. Incredible amounts of revenue. Look at the free cash flow jump from 1 year to the next, $3.81 billion to $27 billion. So they're justifying this so far, but the big question is, how long can Nvidia keep this up? Can they maintain this level of growth, this level of momentum? How long is this going to last? Because it seemingly never ends. Here's a video that I think is interesting. This is from the Dean Evaluation, and this is from 6 months ago. So just 6 months ago, he had a price target of $240 per share for Nvidia. Here is his reasoning.
I mean, this stock was $30 6 years ago. So, and it's had near-death experience of its dropped 50, 60, 80%. You know, these are companies where if the momentum shifts, you can very quickly see a route in the other direction. You've seen this on Tesla, and I think you could see this in Nvidia as well. So if you haven't been lucky enough to add Nvidia yet, I think that there will be a point somewhere in the next year or two when fear is greatest. You will not feel comfortable buying Nvidia at 150 because everybody's going to be fleeing. These same equity research analysts who put out buy recommendations with the stock it's 470 are quick to put out sell recommendations with stock it's 150.
He was warning about Nvidia when it traded at $470 per share, and it's nearly doubled since then. So this is a stock that continues to defy most people's expectations. It's trending with a ton of momentum, and we're going to see how long that lasts. Now, the second best performing company is one that I'm not familiar with at all. CEG, or Constellation Energy Group, is up 48% year to date. This is one where I think it's just an electric company. I don't know what they're doing. I don't know why the stock is up so much over the past year, up 122%. But I do know that energy companies can be very cyclical, very volatile, very boom and bust. So I wouldn't expect this one to be a long-term compounder. Maybe it could be, but just on first glance, I think it's one that's just riding some wave. In third place, we have Meta with a 42% gain this year, continuing along with very strong momentum. Mark has been making all the right moves. He's been using AI to improve their ad technology. He's been focusing on the core business, increasing cash flows, and Meta has been a big winner over the past year, up 171%, up 45% year to date. One of the shocking things to me about Meta is how big the company is, how many users they already have, and how they're able to still continue to grow their top line. They've really proved that, which is incredible. In number 4, we have AMD, which is up 41% year to date. This one I believe is getting overflow demand from Nvidia. At this point, it's basically a package play with Nvidia. They're both doing somewhat the same thing. Nvidia is doing it a lot better, but AMD is benefiting as well. And then number 5, we have a pharmaceutical company, Eli Lilly, which is up 36%. Now, there's no secret why these pharmaceutical companies are doing well. They've came out with a specific type of weight loss drug. And Eli Lilly is supposed to have one that's going to make a lot of sales. So it's making the revenue go up. It's making the earnings go up. Things are headed in the right direction. Investors are very excited about that, causing the stock to go up big. So it's one of the biggest winners in the market this year. After that, we have Uber. Uber's in the green this year by 31%. And this has been a story of an unprofitable company That was one of the free cash flow negative companies that had a lot of stock-based comp. It seemed like it was just not a great company a couple years ago. Well, the CEO really committed to generating cash flows, and he's done it. In 2023, they generated $3.36 billion of free cash flow with $2 billion of stock-based comp. So for the first time for a full year, their cash flows exceeded their dilution. The story of a company growing revenues while growing margins and becoming GAAP profitable is a great story for investors, pushing the stock price up nearly 40% this year. In number 7, we have a company that I'm very interested in. It's Applied Materials. The stock is already up 36% year to date, and it still trades at a decent free cash flow yield and PE ratio. So I wouldn't be surprised if this one continues to climb. And then in number 8, we have Tapestry, which is up around 30% year to date. This one's a bit surprising, but when you look into it, it makes sense. And it may look like this company is just growing and growing, but in reality, it's basically been flat for the past year. Even zooming out 5 years, the stock is really cyclical. It has booms of demand, then it has time periods where it has lower demand. So I don't believe this one is a reliable grower. I think it's just going through a good period. And then in number 9 of the best performing stocks this year, we have Netflix. We've already talked about it, but it's up around 33% this year, off to a really good start. Number 10, the last one we're going to be looking at, is Juniper Network. Now this one's another one where it's a special situation. You can see that the stock had a dramatic and sudden rise year to date. The stock went up dramatically on the 9th of January because there was talks of Hewlett Packard buying Juniper Network. So they're going to be acquired. When they're acquired at a premium, which means the stock price goes up for the company that's being acquired. So that's what happened in this case. Under normal circumstances, this would not be a top performer. So that's the top performing. We have the pharmaceutical company with their new drugs for weight loss. We have Nvidia, we have AMD, the semiconductor companies with the AI trend. We have Meta, which is just killing it. We have Netflix, and we have Applied Materials. These type of stocks are doing really good this year. This is the type of thing that's working right now. Now let's go ahead and take a look at the type of stocks that are not working this year, the ones that are really being sold off. These are the 10 worst performing stocks in the index year to date. And at the very top of the list is one that I have been very outspoken against this stock, which is Paramount. Paramount Global is down 30% year to date. A lot of investors bought Paramount because of the relatively low valuation. It trades at a really low PE ratio. So they bought it because of that reason, and it's just been a disaster. Down 30% year to date, over the past year down 53%. When I look at streaming services and I see the direction things are going, it's just not with legacy media. It's not with cable TV assets. People want streaming over the internet, ubiquitous on all of their devices. The company that offers that the best is Netflix. And Netflix's stock is up 99%. Paramount's is down 53% over the same time period. And I see this as the problem with Paramount going forward. It's just too subscale. It's not able to make the jump to streaming effectively. So Paramount's the biggest loser this year after already having a really difficult 2023. Now the next closest loser, number 2, is another company that's in the same type of category, Warner Brothers Discovery. Warner Brothers Discovery likewise is down 30% year to date, and over the past year down 46%. This is again another company that's in that situation of being subscale with streaming, but having to use all of their legacy assets, their cable TV assets, their movie production assets, and they're trying to make money that way. So there's a lot of negative momentum here, and the stock price is moving down dramatically. In number 3 worst performing, we have Charter, down 27% year to date. This stock is having a tough time for a couple reasons. Right here we can see the stock dropped around 16% in a single day. That was because of their earnings report, where they lost customers. Again, it's easy to see where the trends are going. It's going away from companies like Charter. It's going to companies like Amazon Prime Video, Apple TV Plus. It's going to Disney Plus. It's going to Netflix. It's not going into companies like Charter. So as this secular trend's playing out in media, you can see the winners and the losers. The 4th worst performing holding in the S&P 500 is a company called MarketAxess, which is down 26% year to date. They're a company that gives liquidity and they're a brokerage for bonds. And as we had a report here that there's less bonds being issued, the stock dropped dramatically. So that explains their poor performance this year. Now, number 5, we have ADM, Archer Daniel Midland Company, which is down 26%. This one is down for a peculiar reason. It's down because the government is looking at their accounting practices. And this is not what investors want to hear. ADM accounting scandal zeroes in on nutrition unit that was key in boosting exec stock bonuses past $70 million. It's just a terrible headline for a company. You have Apparently, executives, it could be self-serving, doing things with accounting to make it so they have bigger bonuses. I haven't looked into the whole story, but anytime you have this type of headline, anytime this happens, the stock is going to go down. So it's down 27%. Most of this was in the day that this news was announced. Now, number 6, we have Humana, which is down 24% year to date. This is a health insurance company that's down because of poor guidance on their calls. So they had a big drop after hours. Now, number 7, we have a ticker symbol here, PODD. This is down 24%. The company is called Insulet Corporation. And the name Insulet is representative of the company providing insulin. That's their product that they provide, is insulin pumps. The reason that the stock went down is because investors are now concerned that all these weight loss drugs, where they used to be insulin treatment, will reduce the sales in this company. So this company's primary product is being negatively impacted by all these big pharma companies making these new weight loss drugs. In number 8 of the worst performing year to date in the S&P 500 is Tesla. Tesla's down currently 24% year to date. Just today, it's down 7.3%. Tesla shares are trading lower after the company reportedly saw a decline in February China sales. If we look at Tesla's stock price and the performance of it over the past couple of years, it really peaked in 2020. That's when we got the first big peak from Tesla, and it still has not risen to that level even 3 years later. Going on to year 4 now, Tesla has still remained at that same level. I think the company was dramatically overpriced in this territory. It was just bid way too high, and now it's starting to have the fundamentals catch up for it. But there's still a question of how good the fundamentals will be in the future. When people ask me why I don't invest in Tesla, it's not just because of valuation. When I look at Tesla and I compare it to companies like Amazon, I just like Amazon more. I think the robotics story is better with Amazon, the automating warehouses, the AI story, the cloud hosting. There's so many businesses from Amazon that I like more than comparable companies like Tesla. Now, in number 9 of the worst performing companies in the S&P 500 this year, we have Boeing. Boeing has been a disaster for a long period of time. It's down 20% year to date. Over the past 1 year, it's down 5%, so no gains in the past year. In the past 5 years, it's down 53%. So you can zoom out further and further and further with this company. Bad returns almost any period of time. When I look at the qualities and characteristics of a stock, Boeing has almost all of the ones that I don't like to see. The only one that you could say is a positive is they are a duopoly. They have a large market share, but almost everything else is a negative for this company. And on top of that, you have a culture that seems to have a huge issue with safety first. We saw the MCAS system. We saw the disaster that was, crashing 2 planes within a 6-month period, killing 300 people in the process. And now they have planes where the doors are falling off in the mid-flight. Doors are literally falling off the planes. So there needs to be big changes with Boeing. Investigations, employees that are changing, executives, something needs to change with this company. And then finally, the 10th worst performing stock in the S&P 500 this year is a gold mining company that's just going through a cyclical low. So there isn't any specific reason this company is doing poorly. It's just down 19% because they're not doing as well this year. There's no big reason why. So if we look at the worst performing stocks this year, the top 3 of them are related to legacy TV, cable TV trying to make a transition to streaming. Then we have companies that are in accounting scandals. We have Tesla, which has had valuation issues for a long period of time. We have Boeing, which has had repeatedly bad news. And we have a couple companies that are cyclical. But overall, luckily for the market, the biggest companies in the market, the Nvidias, the AMDs, the companies like Microsoft are doing really well. And since they make up such a large market cap, they're pulling the indexes further and further into the green. So you can thank big tech and these big semiconductor companies for getting your portfolios in the green if you're invested in ETFs. They're doing the heavy lifting. I hope you thought this video was insightful. If you want to see more content, just make sure you're subscribed.